This morning, when you bought your coffee, you paid a tax. When you filled up your gas tank, you paid a tax. When your employer direct deposited your paycheck into your bank account, a tax had already been quietly taken before you even opened the app. Nobody sent you a notice, you didn't sign anything, no line item, no receipt. And here's the part that should genuinely bother you. This tax is more reliable than income tax, more universal than sales tax, and every single administration, Democrat, Republican, it doesn't matter, has collected it, consistently, silently, for over 50 years. It's called inflation.
But before you check out, this is not the prices go up, purchasing power goes down explanation you got in high school econ. That version is technically true and completely useless. What I'm going to show you is how the mechanism actually works, what's happening inside the system, what the numbers look like when you do the math nobody does for you, and why the people running the system have every incentive to make sure you never think about it too hard. For most of the 2010s, inflation in the US ran between 1.5% and 2.5%. Quiet, forgettable. The Fed called it well-anchored. Nobody talked about it at dinner. Then 2022 happened. Inflation hit 9.1%, the highest in 40 years. Groceries, rent, gas, utilities, everything moved at once. People noticed. People complained.
And then, over the next 2 years, it came down. The Fed raised rates, the headlines relaxed. By 2024, we were back in the 3% range. Crisis over, apparently. Except, go check what a dozen eggs cost in 2019. Then check today. They didn't come back down. Nothing came back down. Prices stabilized at their new higher level, and everyone just quietly accepted that as the new normal. That acceptance, that moment where people stop asking why, that's exactly where the system wants you.
And then, over the next 2 years, it came down. The Fed raised rates. How the system actually works. Let's start with a question that sounds simple. What is money? Most people say it's a medium of exchange, a store of value. Sure, but there's a more precise definition. Money is a claim. It's a promise from the government that this piece of paper, or this... And then, over the next 2 years, it asks who controls how many of those claims exist. In the United States, the answer is the Federal Reserve, working in close coordination with the Treasury. And here's where it gets interesting. The US government consistently spends more than it collects in taxes. That gap, the deficit, has to be funded somehow. So the Treasury issues bonds, it borrows, and those bonds get purchased by financial institutions who get their liquidity, their capacity to buy those bonds, from the Fed. New money enters the system, not printed on a press in a dramatic scene, just new numbers, created, digitally, at scale. More dollars chasing roughly the same amount of goods and services. You know what happens next. This is not a conspiracy. This is published Fed policy. It's in the meeting minutes. It's in the academic literature. The Fed has an explicit 2% inflation target, meaning they are, by mandate, trying to make your dollar worth 2% less every single year. And they consider that healthy. The uncomfortable math. Let's make this personal. Say you have $10,000 sitting in a savings account. Your bank is offering you, let's be generous, 4.5% interest. You feel responsible. You're saving. Now factor in inflation at 3.5%, which is where we've been recently. Your nominal return, 4.5%. Inflation, 3.5%. Your real return, roughly 1%. That sounds fine until you account for federal income tax on that interest, which most savers pay. At a 22% bracket, your 4.5% becomes about 3.5% after tax. Real return now? 0, maybe slightly negative. And that's in a relatively good environment. Run this math during the 2022 spike when inflation hit 9% and savings accounts were still paying under 1%. You were losing 8 cents on every dollar per year, automatically, guaranteed. Nobody sent you a bill. Nobody called it a loss. Your balance went up, but its purchasing power went down. There's a word for this. Economists call it negative real interest rates. What it means in plain terms is the system is charging you for holding cash. Now, here's the part that really doesn't make the news. The US government currently carries over $34 trillion in debt. Most of that debt was issued in previous years at the dollar values of those years. When inflation runs hot, the government pays back that debt in cheaper dollars. A bond issued when a dollar bought more gets repaid with a dollar that buys less. Inflation is, functionally, a debt reduction strategy for the federal government. They borrow in today's dollars and repay in tomorrow's slightly less valuable dollars. Every year, automatically. This is called inflating away the debt. It is not an accident. It is, historically, one of the most common ways governments have managed excessive debt loads, going back centuries.
Hype versus reality. Here's the thing about how inflation gets reported. When the CPI drops from 9% to 4%, the headline reads, "Inflation falls." And technically, that's true. The rate of increase slowed. But that framing obscures what actually happened. Prices didn't fall. Nothing got cheaper. What happened is that prices rose 9% on top of the previous year's prices, and now they're rising another 4% on top of that. The base keeps moving up. The floor never comes down. Between 2020 and 2024, grocery prices in the US rose roughly 25% in total. That's not a statistic that reverses when the monthly CPI print looks better. And the burden of this does not fall equally. People who own assets, stocks, real estate, businesses, have a natural hedge. When inflation runs, the nominal value of those assets tends to rise with it. A house worth $300,000 in 2019 might be worth $420,000 today. The owner didn't get richer in real terms necessarily, but they didn't get poorer either. The people who get hurt are the ones sitting in cash, fixed income retirees, people living paycheck to paycheck who can't invest, younger workers whose wages haven't kept pace. The people with the least financial flexibility absorb the most damage. Inflation is not a neutral tax. It is a regressive one. It takes proportionally more from people who can least afford to lose it. The bigger picture. Now, step back further. In 1971, President Nixon ended the convertibility of the US dollar to gold. Before that moment, the dollar was theoretically backed by a real finite commodity. There was a constraint on how many dollars could exist. After 1971, power needs resources. And throughout history, one of the most reliable ways to extract those resources has been to quietly devalue what people already hold. So what do you do with this? I'm not going to give you a list of inflation hedges. That's not what this is about. And honestly, that's not the most important question. That money didn't come from productivity. It didn't come from gold. It was created. And every time new dollars enter the system, the existing dollars in your wallet and your savings account and your paycheck represent a slightly smaller share of the total. Economists call this seigniorage, the profit a government makes simply from issuing currency. The more important question is this. If inflation functions as a tax, and by every economic definition it does, why isn't it disclosed as one? Why doesn't the federal budget include a line that reads, "This year, through monetary expansion, we transferred approximately X trillion dollars in real purchasing power from savers and wage earners to debt holders and asset owners"? Because if they said it plainly, they'd have to call it what it is. And the second question, the one that tends to... The Fed's official target is 2% inflation per year. That's not a side effect. That's the goal. Which means the plan, the stated, published, official plan, is for your dollar to be worth about 45% less 20 years from now than it is today. And most people will go their entire lives without ever being told that directly. Whether that bothers you and what you do about it, that's up to you. But you can't say nobody mentioned it.